International Private Equity. Book summary by Eli Talmor and Florin Vasvari. Imagine a world where financial empires are built, not on the trading floors of Wall Street, but in the shadows. Where silent power brokers pull the strings of industries, not with stocks, but with billion-dollar deals negotiated in secret. This is the world of private equity, a high-stakes battlefield where fortunes are made and lost in the blink of an eye. It's a world where the right investment can turn a struggling business into an unstoppable juggernaut or leave it in ruins. Where CEOs are replaced overnight, where entire industries are reshaped by firms that most people have never even heard of. Welcome to the world of high-stakes investing, a place where the bold thrive and the unprepared get left behind. Where access to capital isn't just a privilege, it's a weapon. And today, we're going deep into one of the most powerful yet misunderstood forces in modern finance: private equity. This isn't just about making money, it's about playing chess at a global scale. Buyouts, leverage takeovers, billion-dollar turnarounds. Each move can make or break entire companies. And while some see private equity as the fuel that powers innovation, others call it the corporate villain lurking in the shadows. But what really happens behind closed doors? How do these mysterious firms operate? And most importantly, who wins and who loses? Today, we're breaking it all down through the lens of one of the most definitive books on the subject, International Private Equity by Eli Talmor. Buckle up, because once you step into this world, there's no looking at business the same way again. 1. What is private equity? So what is private equity? It's not just about buying stocks and hoping they go up. No, this is a whole different level of investing. Unlike the shares you can trade on Robinhood or the New York Stock Exchange, private equity deals happen behind closed doors. They operate in the shadows, moving billions of dollars with a single decision, completely outside the public eye. A high-stakes business meeting, suits, documents, and intense discussion. A contract is slid across the table. A fountain pen clicks, a signature is made. Private equity firms don't just buy stocks, they buy entire companies. Then, like master sculptors, they reshape them, cutting costs, restructuring operations, and driving up profits before selling them off for massive returns. And the way they do it? Through specialized funds, powerful investment pools backed by pension funds, university endowments, and the ultra-wealthy. Money flows in, companies are acquired, value is created or destroyed, and if everything goes according to plan, everyone walks away richer. Step 1. Raising funds. Step 2. Investing in companies. Step 3. Restructuring and growth. Step 4. Selling for profit. Think of it like this. If the stock market is a supermarket where anyone can shop, private equity is a VIP auction house, where only the biggest players get access to the rarest, most valuable assets. It's not about browsing the shelves, it's about owning the store. But this isn't just about money, it's about power. Private equity firms don't just invest in businesses, they control them. They decide which companies thrive and which ones get stripped down, sold for parts, or left behind. For better or worse, private equity is one of the most powerful forces in the business world today. And whether you realize it or not, it's shaping the companies you buy from, work for, and invest in. The question is private equity a force for innovation or destruction? That depends on who you ask. But one thing's for sure, once you understand how it works, you'll never look at business the same way again. 2. The power players. Who runs private equity? Private equity is ruled by a select group of power players. Firms so influential, their decisions can shape entire industries. These firms are led by elite investors known as general partners, GPs, the strategic masterminds who call the shots, make the high-risk, high-reward decisions, and ultimately decide the fate of companies worth billions. But behind these power brokers, there's an even bigger force at play: the money. And where does it come from? Enter the limited partners LPs, the silent giants of private equity. These aren't individual traders sitting behind a computer screen. No, these are pension funds, university endowments, insurance companies, and ultra-wealthy investors. They supply the capital, entrusting it to the GPs, hoping for outsized returns that they could never achieve in the traditional stock market. These firms don't just invest money, they take over companies. They don't sit on the sidelines, waiting for the market to move. They become the market. When a private equity firm buys a business, everything changes. Nothing is sacred. Costs are slashed, operations are optimized, and leadership is often replaced with new executives who answer only to the investors. The goal? Maximize returns at all costs. Sometimes, it's a life-saving turnaround. A company on the brink of collapse gets a second chance, fueled by expert restructuring and aggressive expansion. Think of it like a paramedic rushing in to revive a dying patient, performing emergency surgery, and sending them back out stronger than ever. But other times, it's corporate butchery. Assets are stripped, employees are let go, and once the company has been milked for every possible dollar, it's sold off, or worse, left to crumble under the weight of debt. And here's the thing. Whether you see private equity as a force for innovation or a corporate predator, one fact remains. It's one of the most powerful, secretive, and lucrative forces in the business world today. The money behind these firms funds the startups of tomorrow, transforms struggling businesses into giants, and dictates the future of global industries. 3. The dark side, the risks and controversies. Private equity isn't always a hero's game. Some call these firms corporate traders, accusing them of cutting jobs, stripping assets, and leaving companies drowning in debt. And they're not wrong, sometimes. Because for every miracle turnaround, where private equity swoops in, fixes what's broken, and revives a failing business, there's another story, one where a company gets loaded with debt, squeezed for profits, and then left to collapse under its own weight. It's a high-stakes gamble, and sometimes the biggest losers are the employees and customers left in the wreckage. One of the most powerful and dangerous tools in private equity is the leveraged buyout, or LBO. It's how the biggest deals get done and how companies either soar to new heights or crash and burn. Here's how it works. Imagine you want to buy a house, but instead of paying cash, you take out a massive loan. Then, you make the house itself responsible for paying off the loan, even if it can't afford it. That's exactly what happens in an LBO. The private equity firm buys a company with mostly borrowed money, then forces that company, not the investors, to pay off the debt. When it works, it's genius. The business grows, profits explode, the investors cash out with massive returns, and everyone wins. But when it doesn't, the debt becomes a ticking time bomb. Interest payments pile up, layoffs begin, costs get slashed to keep up, and in the worst-case scenario, the company goes bankrupt. Take Toys R Us, for example, a household name, a childhood staple. In 2005, it was taken over in a massive $6.6 billion leveraged buyout. But the weight of that debt crushed the company. By 2017, it had no cash left to invest in its stores, compete with Amazon, or keep up with a changing retail world. And just like that, a beloved brand disappeared. Not because people stopped shopping there, but because private equity had bled it dry before it even had a chance to fight. But here's the thing, not all leveraged buyouts end in disaster. In fact, some of the biggest and most successful companies in the world were built on private equity takeovers. So what's the difference between a good LBO and a bad one? Simple: strategy, execution, and timing. The best private equity firms don't just buy companies, they build them. They invest in growth, leadership, and innovation. And in those cases, everyone wins. 4. Why private equity matters and why you should care. Love it or hate it, private equity isn't just another part of the financial world. It's the engine behind some of the biggest changes in the global economy. From the birth of tech unicorns in Silicon Valley to billion-dollar infrastructure projects in Asia, these funds are moving money in ways most people never even realize. They take risks that traditional banks won't, backing bold ideas and ambitious founders. The results? Revolutionary technology, global expansions, and even entire industries reshaped overnight. In fact, today's private equity industry is bigger than the entire GDP of some countries. These firms aren't just making investments, they are making history. But here's the thing. Private equity isn't just about money. It's about power, influence, and the future of business itself. It's about who gets funded, who grows, and who gets left behind. For every tech startup that goes public, for every industry that gets a second chance, there's another company that's been restructured, rebranded, or completely wiped out. This is the double-edged sword of private equity. So whether you're an investor, an entrepreneur, or just someone who wants to understand how money really moves, one thing is clear. Understanding private equity is understanding the future of business. Because in today's world, the biggest decisions aren't made in the stock market. They're made in the boardrooms of private equity. And if you're not paying attention, you're already behind. So what do you think? Is private equity the fuel that drives innovation and economic growth? Or is it a ruthless machine prioritizing profits over people? Are these firms the architects of the future or the villains of capitalism? Whatever your take, one thing is undeniable. Private equity is everywhere. It's shaping the businesses we buy from, the jobs we depend on, and even the technologies we'll use tomorrow. And that's why it's more important than ever to understand how it works. Because whether you realize it or not, it's already impacting your life. So tell me, what's your take? Is private equity a necessary force of capitalism, or is it pushing the system to the breaking point? Drop your thoughts in the comments. I read every single one. And hey, if you enjoyed this deep dive, smash that like button, subscribe for more, and hit the bell icon so you never miss an episode. Until next time, stay curious, stay informed, and stay ahead. Because in the world of finance, the real power isn't just in money, it's in knowing how it moves.